Good afternoon, ladies and gentlemen. This is Robert Rayburn here at Life Pro Asset Management. Thank you so much for attending this week's market update. We know it's an important one. There's been a lot of pain over the last 4 or 5 days as it relates to the broader market, but in particular, some of our strategies have obviously underperformed over the last week. So what we want to do today is really understand, why is that happening, right? Why are our strategies underperforming the broader market? What are the factors driving performance, whether that's to the upside or the downside? And in particular, when are we expecting a broad recovery, and what's going to drive that recovery? I think all of these are really important points, because right now there's some uncertainty out there as it relates to the reopening, as it relates to the impact of the COVID Delta variant. So we want to understand these factors, but in particular, we want to understand when some of that uncertainty is going to decrease and when we can expect a broader recovery across the entire portfolio. So let's go ahead and get started. As we can imagine, the title for this week's presentation is called Navigating Uncertainty. And we're really, at the end of the day, we're going to tackle three things this week. We're going to do a performance review. We haven't really done that in a month or so. We want to make sure that we're keeping clients up to speed as to where we are performance-wise. We do that about once a month now, so that we can pay attention to more market content in these presentations. Secondly, what is causing that weakness in energy and cyclical stocks? The portfolio is heavily geared toward the reopening, cyclicality, energy, materials, the banks. We want to know what's driving that performance right now. And then third, something we've never done before, which is a case study of some of our largest investment holdings. We want to go into the fundamentals so that we can show viewers why we own these companies, right? We talk a lot about macro and the Federal Reserve and the state of the recovery and how that drives stocks, but why do we own the actual companies that we do? And I think that'll give viewers and investors a lot of comfort and excitement in terms of where these companies are going to be going over the next few years. Now, in terms of the performance, what we can see here is, after obviously a very strong 2019 and 2020, up over 100%, we're down about 19.45% in 2021. This has led to a fairly sizable underperformance versus the market. We know that. It kills us. We outperformed the market by 85% last year. We cannot say that this year. We take a lot of pride in our performance numbers, and obviously we can never guarantee anything, but we always want to make sure that we're doing to the best of our capability to generate returns. So really, what has driven this performance this year? What has driven this minus 19% number? Really, from January to February, we were overweight technology, and we had that big drawdown. We had that sell-off in technology stocks, and it was at that point we noticed something. We noticed that the long-term trend for technology had started to buckle, had started to crack, had started to deteriorate from a longer term standpoint. Valuations suddenly mattered, and there was a lot of downside. And so us as an active manager, we must manage risk. And when we see the potential for 30, 40, 50% sell-offs, we want to move to the sidelines. And that's what we did with technology. After 10 years of being in technology, whether it's here at Life Pro or at my prior firm, we moved to the sidelines. It's what's driven our performance for the better part of a decade. So it was a tough decision, but when we look back, it was the right decision to at least sell technology stocks. From February to April, we rotated away from technology, we eliminated that weight, and we went into the more cyclical part of the stock market. So that would be energy, materials, the banks, industrials, consumer discretionary. Those are the 5 core sectors that we're invested in. But something happened. COVID Delta hit at the end of May, right as we were finishing our rotation, and that has driven a lot of the underperformance from May through to today. So that externality, it's something obviously, we're not here to, we wouldn't be able to predict when a next strain hits the US, But because that strain hit right as we were finishing that rotation, that certainly did hit that performance, and that what we see today. And we can see that here in the chart. So we finished our rotation right here around May 31st is when we really started to complete that overall rotation away from technology after 10 years and into those cyclical, more cyclical, economically sensitive stocks. Then COVID cases started to bottom and then really turn upward here in the month of July. And we know that especially in July and the last week or so is really where we saw a lot of that underperformance accelerate. So it is important to understand the why of the underperformance, because we know at that point what are the factors that are driving asset prices down. So we can also track and pinpoint those factors. So when they ease off, we know that those asset prices, just not know, but we have a high degree of confidence that those asset prices will rise as a result. So you can see here just a big increase in the Delta variant across the US. Now, fortunately, something that we're seeing here over the last few days is that Florida cases have now started to peak out. Missouri cases have started to peak out. In fact, Florida has started to turn negative change day over day. A day doesn't make a trend, but that's the first sign of that 40 to 60 day window starting to play out. So we want to keep a really close eye on that, because when things turn, they can turn quite violently. So the last time we had a big sell-off, of course, was in February to March of 2020. So what we look at here is the opportunities unit price. This is an internal unit price we use to measure our performance. We started at 100 when we started the strategy. So at $184.75, that was the unit price on February 19th of 2020. Between February 19th and March 18th, so basically a month, the strategy sold off 36.09% as shutdowns roiled the US economy. That was painful. Now, obviously, the entire market was bad at that point as well. But notice what happened. Once things turned, they turned violently and quickly. So in other words, we have about a 37% rally between March 18th and April 18th. Now, of course, with math, a 36% sell-off, you need more than a 37% rally to get back to break even. But notice what we see here. We now had a 59.26% rally between March 18th and May 11th, and a 69.42% rally between March 18th and May 22nd of 2020. In other words, once things rotated back in, they rotated quite viciously back toward the upside. And we are maybe not expecting the same degree of rotation in terms of the violent upside, but we are expecting a very sharp recovery over the next 3 or 4 months in our particular strategy, because those drawdowns have been in the 25 to 30% range. And when things turn, they're going to turn very rapidly to the upside. And we want to make sure that we're invested, because these are great companies, as we're going to show our viewers here in a couple of minutes. Just a reminder, the long-term thesis, why we made that rotation, is that the long-term trend for tech and healthcare started to break in February. This was the first time we saw a big break in trend. All these other blips were the market as a whole. This is the first time we saw a big break in the trend that started in 2011. That's a very important point. We also saw a break in the trend to the upside for energy and financials. When these broad asset classes start to rotate, they tend to symbolize a long-term trend change that are measured in years, not in days or months. And in the shorter term, what we see, of course, is that the overall rolling 65-day sum of cyclical sector ETF flows is extremely oversold, while bonds are extremely overbought. So we are in a position right now where things are just so oversold in these particular sectors. Obviously, the market as a whole is not that oversold, but in where we're invested in is very oversold. So we expect that big recovery when it does turn. So what are the factors that are driving our energy, materials, and financials thesis? oil and copper demand continue to march higher. We're seeing an infrastructure super cycle emerge in the US and in Europe in particular. It's important to remember that Europe is larger than China as from a GDP standpoint, right? So Europe and the US are both rebuilding infrastructure. That is going to have just as large of an impact as China did on commodities from 2000 to 2010. And we remember how strong commodities were back then. OPEC spare capacity. So for those who are not familiar, OPEC is the cartel of countries in the Middle East and in Latin America, plus Russia, that control global oil production outside of the US, basically, and set prices to the best of their ability, or set production quotas to the best of their ability. Most of that spare capacity is going to be spent, this is actually a typo, by 2022, not 2021. So by the summer of 2022, we expect most of that spare capacity in OPEC to be used up. So who's the swing producer? The swing producer is the US, those shale producers that can immediately go online, increase production as they did in the between 2010 and 2016. Here's the problem. After a 6-7 year bear market in energy, there's been no investment in new wells or mines on the material side over the last 5 years. So that ability for copper or oil in the US, or basically outside of OPEC for oil, and then just global copper supply in general, to respond to higher demand has been impaired from a multi-year standpoint. And that's an extremely important point that we have to keep in the back of our minds. As OPEC spare capacity dries up, it is going to drive up oil prices because we're still using more and more oil every single year. We are over a decade away from making that transition to renewable energy. We just don't have the technology for energy storage. Fourth, higher economic growth is going to drive long-term growth rates higher. When we look at higher government spending, we're only in the second year of the recovery. That should drive the long end of the yield curve to the upside. And for the first time, we're starting to see signs of a re-leveraging cycle. So people are actually utilizing bank loans. Remember, for the last 10 years, we've been deleveraging. Now we're starting to re-lever, especially for Americans that want to get into the housing sector. They can't pay cash for it if we look at housing prices. And then lastly, a broad reallocation of the market away from mega cap technology. We're already seeing the cracks in those technology shares. Now it's about getting the other area of the market to work, and that's where we're invested in right now. So our stocks versus Fang. So some of the largest energy stocks that we currently own in the strategy: Slumber J, Canadian Natural Resources, Occidental. Let's look at the free cash flow yield. When we look at 2020, 2021 free cash flow yields, what we see, especially with CNQ and Occidental, we have free cash. So free cash flow, for those who don't know, it is your revenue minus your expenses, minus your taxes, and then once you got your earnings, minus your capital expenditures. What is that free cash flow that the company is generating divided by the share price? A higher number is really, really good. Right now, CNQ and Occidental have a free cash flow yield of 23.6% and 28.57%. In other words, almost a quarter of the company's market capitalization is being generated in free cash flow. Versus, we look at Google, Amazon, and Facebook. Yes, they generate a lot of dollars, but their free cash flow yields are significantly below that of major energy stocks. Now, we're using examples from our portfolio, but we can go across the board, whether it's stocks that we own or don't own. Slumber J, 7.8% yield versus 2 to 4% in the mega cap technology space. Now, let's look at Slumber J real quick. And this is something we do here at LifePro. We dig into the financials. We invest in companies, right? So back in 2016, Slumber J was worth $117 billion. Today, it's worth $37 billion. the product of a prolonged bear market in energy. Okay, so what are we getting for the $37 billion price tag that we get when we buy Slumber J stock? So back in 2016, this company generated $27.8 billion of revenue. Okay. Today, it's generating about $22.9 billion revenue. But here's the kicker. And remember, we've talked about this before. These companies are just so much more profitable now than they were 5 years ago. The gross profit margins on Slumber J used to be 12.2%. Today, they are 20.3%. They've almost doubled their gross profit margin. And look at the impact that is having. Because the gross margins are so much higher than they were 4 or 5 years ago, Slumber J has now increased their earnings per share from $1.14 to $1.24. In other words, even though the company is 68% lower in price than it was 4 years ago or 5 years ago, its earnings per share is actually higher than it was 5 years ago. So you're getting more earnings from the stock from 5 years ago, but for a price tag that's 68% lower. So 68% lower price, you're getting higher margins and you're getting higher profits. Is that a company you'd be interested in investing in? For us, this is a multi-year investment. Let's look at another company, Occidental. From 2017 to today, the stock price is 64% lower in value. But notice the revenue. Revenue has gone from 12.5 billion to 19.5 billion in the last 12 months, and it's projected by the end of this year to be around 25 billion. Okay, so remember that. We've gone from 12.5 billion to 25 billion in revenue, and the share price is 64% lower. Earnings, meantime, have gone from 88 cents to 98 cents. So we have higher earnings, higher revenue, but a 64% lower stock price. Here's the real kicker. Free cash flow, remember, that is revenue minus expenses, minus your taxes, minus your capital expenditures, has gone from 1.26 billion to 4.3 billion over the last 12 months. And by the end of this year, it's projected that Occidental will generate 6.8 billion in free cash flow. So you're getting almost 5 times the free cash flow that you did in 2017. This year, you're getting 5 times the free cash flow you did in 2017, but you're getting it at a 64% lower stock price. So 64% lower stock price, higher revenue, higher profits, higher free cash flow. Is this a stock you want to invest in? Cleveland-Cliffs. Here's one stock that the stock price is actually higher than it was in 2017, but it has 10 times higher revenue and 17.8 times higher free cash flow. So the market cap has gone from 2.1 billion to 11.6 billion, but the revenue has gone from 1.86 billion to 20.5 billion projected by the end of this year. And its earnings have gone from $1.62 to projected at the end of this year of $5.83. In other words, this stock is trading around 5 times earnings from the end of this year. That's insanely cheap. Then we look at the free cash flow going from 167 million to almost 3 billion in free cash flow. Now, for all of these companies, where we're talking about Cleveland-Cliffs, Occidental, or Slumber J, what are they doing with that free cash flow? A lot of times they're not putting it back in the business, they're paying their debt down. So what happens when we pay our mortgage off? Well, we capture more equity value in that house, right? Our equity value goes up as we pay down our debt. And that's exactly what's going on with these companies. But why are the stock prices lower over the short term? The stock prices are lower because of the virus. People are assuming, well, COVID Delta variant is going to lower GDP. You see it playing out in the bond market with lower 10-year interest rates, and therefore we're going to use less steel, less oil, less copper. But we're just not seeing that at the economic level. Activity's up, the economy's growing. And so that's where the opportunity is today, is that these are high quality companies generating billions in free cash flow, trading at single digit to low double digit earnings multiples that are poised to rise significantly if they just go back to where they were in 2017, where they were making, in some cases, less money, less revenue, and certainly much lower free cash flows. So that's the opportunity. That's why we are invested in these companies. And that's why we have so much confidence in their violent recovery over the next few months. And of course, then we look at the bond market. Energy credit spreads, so in other words, that credit risk premium on energy bonds spiked up to its highest point when the oil price collapsed in 2015. But then during the COVID shock, when oil went negative, it spiked again, but again at a much lower spread back in 2015. Why? Because between 2015 and 2020, these companies were cutting expenses. They were becoming leaner. We see it in the margins of Slumber J. We see it in the margins of Occidental. They were becoming leaner. And then look at the credit spreads today. Even though we've had a very sharp sell-off in the company's stock price, the bond prices have barely moved. And that's because these companies are so profitable. And they're delevering the balance sheets. They're cash rich. And that's why we want to own the stocks. We're taking a cue from what's going on over in the bond market. So where do you think dollars are going to flow over the next few years? I don't know about the next day. Maybe we'll open weak tomorrow. Probably will. Maybe we'll have a down week next week. But where will dollars flow over the next few months, years, and beyond? Technology or energy? Technology is up close to 700% over the last decade. Energy is down. We looked at some of those profitability models. Which would you rather buy at this point? So overall, all that's well said. But what do we need to see to get asset prices turned around? It comes down to three factors, ladies and gentlemen, from a short-term standpoint. Economic data needs to continue to show progress. The most important point, we need to see COVID-19 cases plateau and begin to decline. We're beginning to see that in Florida and Missouri. We need that to play out across the country. And then the 10-year yield needs to bottom and continue to push higher. If we get these three factors, this will alleviate some of the artificial discounts that are being placed on energy, materials, the banks, industrial stocks, and we should see a very sharp recovery in these strategies. I really appreciate the patience. I really am empathetic with the volatility that we've all experienced over the last 2 or 3 months. I've personally experienced it. Our family's invested in these strategies. So we are in that boat with you, but we're also extremely confident and excited because we see those numbers. Math doesn't lie. That's why we like doing the fundamental analysis. So if anyone has any questions or concerns, please do not hesitate to reach out to your advisor or reach out to us directly at 888-543-3776. Thank you again for all your time and have a fantastic weekend.